If you wanted to invest in the stock market, it's pretty easy to open up your own investment account. You can do it through iTrade, eTrade, Disnet, or through one of your charter banks. It's easy to open up an account, and the trades are not that expensive, $5 to $7. Just have to make sure that these people don't charge you too much on an annual service fee or something to take away your return on your investment that you're putting in. What I wanted to do this evening is just give you what I've learned over the last few years from investing. And I got 3 principles that I follow in terms of investing in the stock market. Number 1 is be prepared to lose all the money that you put in. And I'll say that with a little bit of a qualifier. You want to invest in stocks that you think are going to make you a lot of money in a hurry. There may be stocks that's going to lose your money in a hurry as well. Just to give you an example, 2 or 3 years ago we had a company, one of our customers come in and they had a really big profit in 1 year. And what they'd done is they'd used their working capital, which is not a good idea, to buy some shares in a company that was called Chem. And that company, he bought the shares, I should say, for $4 to $5. They went to $13, then he sold them, and he made a real nice profit. And Chem was a company that was making a drug to be used in the treatment of, I think it was diabetes. Very promising drug, and as the share price went in line, it got closer to going to clinical trials. The drug really started, or the company shares really started to take off and go up. But what happened is when they went to clinical trials, the drug made people sick, as in ill. They had nausea, and they just had a reaction to the drug and couldn't take it. So Chem went from going from a high of $17, $18, just shut down in a hurry, and that company right now, shares are trading at 10 cents. So if you bought into that company on the way up like that, and it dropped down before you had a chance to get out, you could lose all your investment in a hurry. And number 2 principle, diversify your investment. A great way to start your investment portfolio, if you want to start buying some stocks, is buy shares in one of the Canadian banks, one of the charter banks. Good, solid, dividend, blue chip companies. So to say you start your investment, you go buy shares in the Bank of Montreal. A year or so later, you got a few bucks. You say, okay, I'll go buy some more shares now. Well, to diversify, you wouldn't go out and buy shares in the Royal Bank or CIBC. You go buy shares in, say, Canadian National Railway or CP, which is in the transportation field. Go and buy shares in Petro-Canada, Canadian Natural Resources, Telstra, which is an oil and gas, or buy shares in Fortis, which is a utility. Diversify along different industry lines as well as different company lines. And don't fall in love with your stock. You didn't become engaged or married to it. If your share starts to go down, sell it and take a small loss. Give you an example if you want to think about Nortel. It's once the biggest company in Canada. Shares are selling at $125 a share. So let's just say you invested in that company, you paid $110 a share. After a while, you see the price has gone down to 80. You say, geez, you paid 110, we're down to 80. Can't go any lower. Well, what happened is you went to 70 and 60, and you held on, you were held on all the while until they went to 0. It's better to sell it, take a loss, and move on to another company. And I'm talking about now, if your company is going down and everybody else is staying the same. Remember to the subprime crisis last spring, everything went down. Every stock market in the world went down 35, 40%. But that's a little bit different than your stock going down and everything else going up. Third principle is put your money into good dividend-paying stocks. Let's just say you got a few dollars to invest. You can go out, put that money into a GIC with a charter bank, and they may pay you 2%, maybe. Or you can use your investment account, go and buy shares in the charter bank, and they'll give you a 4% dividend. All the charter banks right now are paying about a 4% dividend. And not only do they pay a dividend, but that share price will always go up and down. About 15, 16 months ago, shares in Bank of Nova Scotia were selling for about $51, $52 a share. When the subprime prices hit last spring, they went down to 28. So 52 to 28, so how's that always going up? Well, as of the day, they're back up to about $51, $52 a share. What I mean by they're always going up, I mean that over time, shares will always go up in value. stroke, or might be like that, or might level off a little bit, but it's always going up in value. First time batch shares of Bank of Nova Scotia, they were trading at $35 a share. They went up to $70 a share, and then they split, 2-for-1 split, so they end up 2 shares, or, you know, for the same price. So nothing, on daily split, nothing happened. Instead of having, say, 10 shares at $70, I got 20 shares at $35. They went up to $70 again, and then they split again. So now I got 40 shares at $35. Those same shares, as of today, are trading at $51 a share. So, relatively speaking, you eliminate all those splits that they did. That one share for $35 that I initially bought will be worth about $190 to $200 today. It always goes up in value over time. And while all that was happening, they were paying a dividend of 3 to 4%. So that's a pretty good rate of return. And there's a rule of thumb in investing that says this. It's the rule of 72. Take your investment, divide it into 72, and that's how long it's going to take for your investment to double. So let's just say you had some shares in the bank. They're paying you 4% dividend. The share itself was going up in value, say 5%. That would give you a rate of return of 9%. So you can take your 9%, divide it into 72, give you 8. So your investment will double in 8 years. Or you can have your money in a GIC at the Charter Bank, 2%, and it's going to double in 36 years. So, over time, where would you rather hold your investment? So, in summary, if you're going to be investing, don't put your money into high-risk accounts. Diversify your portfolio so that you'll mitigate your chance of loss. And 3, put your money into some good dividend-paying stocks.